After more than 2 years of the pandemic, political unrest, floods, fires, and war, now there are fears we might fall back in recession. Russia's invasion of Ukraine drags on. 25 million people in China's biggest city remain under severe restrictions, and interest rates are on the rise as inflation takes off. While record share values have largely held up so far, markets face some serious tests. Inflation is the key issue. US consumer price rises keep accelerating, and the cost of production is rising even faster. That means there's more inflation ahead. Russia's invasion of Ukraine isn't helping. The ongoing war's pushing up the price of oil, wheat, and other major commodities. But even before that, prices were rising sharply as pandemic stimulus stoked demand, while COVID disruptions hit global supply chains. And that could soon get even worse. COVID cases in China are surging. Hundreds of millions of people are living under restrictions. The economic effect of lockdowns is already being felt within China, but manufacturing and exports have been largely immune so far. All this has led to dramatic moves for interest rates, such as those on 10-year government bonds. Australia's are the highest in nearly 7 years, and the US in about 3. And China's 10-year bond yield is now lower than America's for the first time in more than a decade, as traders expect rate cuts to boost a slowing economy there, unlike the US, where Fed officials expect to hike rates rapidly, at least for the next year or two. Added together, these trends could make markets very volatile and raise recession risks.
Inflation has been persistently undershooting economic targets since the 1980s. But now the inflation genie is out of the bottle. Central banks around the globe are moving fast, aggressively jacking up rates in a bid to contain prices. But investment strategist Jared Minack, founder of Minack Advisors, says going too hard, too fast comes with the risk of recession.
This is a classic case of generals fighting the last war. What central banks have been doing really over the last 20 or 30 years is trying to be preemptive with monetary policy in order to hit their inflation objectives. Now, that works if you've got a good way to forecast inflation, but what history has shown is they kept on tightening too early. And as a result, in many economies, including Australia, inflation has persistently undershot central bank targets. So what most of them have done is thrown their hands up in the air and say, look, we're not going to be preemptive anymore. We're going to wait until we see inflation in our target zone, until we see full employment, until we see decent wage growth. And what that has now led to is a quite substantial overshoot in inflation. And now you're seeing a mad scramble amongst a lot of central banks to play catch-up.
That game of catch-up can come with some serious risks, though, can't it?
Oh, absolutely. I mean, look, let's be clear here. In most economies, most central bank tightening cycles end in recession. Since the mid-50s, for example, in the US, there have been 13 Fed tightening cycles, of which 10 have ended in recession. So there's your odds. It's roughly 80% chance that when the Fed starts to tighten, it doesn't stop tightening until something breaks. So that's the historical track record. Now, there is a question about how long it takes till we get to that pain threshold, but every central bank tightening phase comes with risks. Of course, what the central banks are saying is the risk of not doing anything is even larger, because if we do let inflation get really out of control and become embedded in the system, then they would have to keep on tightening to almost guarantee a recession to wring those inflation pressures out of the system.
So with that in mind, how likely is it that the US will head into recession and drag the rest of the world with it?
I think what we're likely to see over the next 12 months is some of the transient factors that really boosted inflation reversing. That'll give spending power back to consumers. Indicators of business investment are quite robust. So I don't think we're likely to get a recession on a 12 to 18-month time horizon. If the Fed does make a mistake, I think the more likely timing for a recession is 2024, that sort of time horizon. So a couple of years away, not 12 months away.
Here in Australia, we obviously had labour force figures out today. The unemployment rate remains historically low at 4%. Inflation is accelerating. We know the RBA is poised to start lifting rates. How is that all going to play out?
Well, here I don't think the Reserve Bank will be as aggressive as the US Federal Reserve for a couple of reasons. Firstly, the RBA has not let inflation reach the excesses that we've seen in the US. In addition, wage growth is very different. In America, wage growth is running at 40-year highs. Here, wage growth is probably still a little on the low side of what the RBA would like, although, to be fair, leading indicators are suggesting that wage growth is about to pick up. But the bottom line is the RBA is a lot less behind the curve than the Federal Reserve is. The other thing that the RBA will be mindful of is that rate increases in Australia arguably will have a bigger impact than rate increases in America. And that's for a couple of reasons. Firstly, most obviously, we have a lot more debt than Americans. In America, household debt to income is around 100%. In Australia, it's closer to 190%. So Australians have got a lot more debt, largely mortgage debt. The second thing is most of our mortgages are still floating rate. So given that the RBA has such a more powerful policy lever, I think it will be more slow in tightening monetary policy. And I actually think rate markets here, which are expecting that the Reserve Bank will push the cash rate to over 3.5% next year, are way too hawkish, and I doubt very much that we'll see those sort of rate increases.
Australia narrowly avoided a recession during the global financial crisis, and we had one of the stronger performing economies during the pandemic, which we're obviously still living through. What's the chance we'll repeat that this time around?
Well, look, I think the success of the GFC and the success of the pandemic response was down to very fast, aggressive fiscal policy. And one of the lessons that Australia learnt in the GFC, and I actually think the rest of the world has learnt in the pandemic cycle, is that fiscal policy works. So given that I'm assuming policymakers won't forget that lesson, I suspect that the next downturn, whenever it comes, should be relatively short-lived, assuming that we get a sharp, aggressive fiscal response, as we've seen in Australia, both in response to the pandemic and in response to the GFC. So with fiscal policy around, I think cycles will be more V-shaped than what we've seen over the last 2 decades.
Jared Minak, as always, great to have your analysis. Thank you.
Thanks, Rachel.